Alright, good morning, Giz. How are you today? Everything is fine? Everything's alright? Let's do the bells. Good morning, everyone. I'm back with you with a special episode today. Stop the bells for a minute. And yes, we have a special episode today, and we are going back up with the yield curve and bond market volatility. And yes, in the past couple of days we had some good news, and yields have come in a little bit. But today I have a special episode for you where I'll try to explain again what I think it's the structure underpinning issue of the debt composition and structure of the UK economy, and why there are some idiosyncratic problems in the debt composition of the overall stock yields that are in a financial stability sense and in a risk management sense, like debt risk management. These features, they are dangerous from a risk management standpoint. And yeah, like, why I'm saying that? Okay, so just take a look at the bond market, and we see that the 10-year yield, I don't know if I hope I can pull up the let's load the pages. Okay, yes, we got it here. So the 10-year yield, as I said, in the past couple of days, it went very, very close to 5%. Yeah, it was a whisker away to 5% in the the closing on the 9th of Jan was 492, 493. It was 5 or 6 basis points close to 5%. But if we pull out, so this week we are having some buying. Yeah, the high was 496, so we were 3 basis points from 5%, and I was really sure that the 10-year would touch 5%, and I still believe the 10-year can go up to 5.5%, to 5 and reach 5%. I'm pretty sure about that, because there are some basic technical factors for what it concerns the chart and the trend. There are some structural factors that I think we have been in the past couple of years in a stage where the bond bull market is over. To me, it's truly over, and yeah, which is a very big call. What I'm trying to say with the bond bull market it's over is that we have had this long downward trend, and we know the trend is a friend. So we saw that yields have gone down since the 1980s. We had a recession in 1980, and then basically 1982, 1983, the Wall Street went back up again, the stock market went back up again, and we have been for the past 30 or 40 years in a bond bull market, or in a secular bull market, what means that yields have gone down steadily, and bond prices have gone up steadily. So bond traders, they should have made a lot of money by on capital gains on the bond price, but they would have not been clipping a lot of coupons, of high yielding coupons. Well, it depends on that security, but anyway. So we see here that basically the trend of the yield curve has been steady down for the past 40 years, but in the past couple of years we had a total reversal. We are now going up, all right? And I strongly believe that the bond market, the bull market for bonds, it's over, and probably we will have structurally higher yields, and we will have a market of because I seriously think that central banks, they won't be able to go back to zero, and they will be forced to price real money, real yields on cash. So we will have Fed funds will have to be 2% real yield or somewhere thereof, and this would be the same, pretty much the same for the Bank of England or the ECB and the BOJ. It's an interesting experiment, everybody knows. And yeah, but I mean, for the main central banks, Bank of Canada, Australia, so I think markets, they will be asking more and more for real returns on bonds, and because we will be in a structurally higher inflation economy due to commodities demand, a lot of money supply that has come out after COVID. So there are a lot of structural features in the economy that would suppose we will have structurally higher inflation, and this will be an idiosyncratic feature that can change from country to country, can have its differences from country to country, and this will require higher real yields, and so that's why the bull market for bonds it's over. And we will have higher yields. Now we see that the 10-year yield came in a little bit, but we are 4.7, and this seems to me the clear setup for a huge breakout of yields, runaway yields. And this is going to break out high. I mean, just analyzing the chart as just chopping and changing around these candlesticks and stuff like that, just if we see the trend. This has been very contained this week, but I think the market is going to be back at that again, and this is going to break out, because here we have a double bottom, and we are just testing a market level, which is 470, 475, but in this week we had the first violation at 497. So the market has tested already a breakout above 475 around this area, 490, but we have a lot of space here, a lot of ground here that basically you can see yields going higher. Yeah, it can go to 5.5%. We can just get this peak of 2007 peak, or we can go and test the 1993 bottom as a sort of technical point from a chart point of view, and it will be 6% yield. So that would be a yield curve breakout and yields going up, and this would be justified by many reasons. It can be fiscal policy, it can be structural deficits, it can be structural higher inflation, although we saw that inflation figures for the UK, they were a bit like old China data. They were really funny to me because I will show you a bit. Okay, alright, so we see what is the yield curve today. The longer duration, 15, 20, 30, 40 years, they are well solid at 5% and above, but we see that the 1 month yield is 4.79 and the 1 year is 4.55, and that means that the market just sees one rate cut for the whole year, yeah, in monetary policy. And yeah, more or less, I mean, we are at levels where the market is reading right what are the data in the economy, and yeah, this was very funny. I mean, because the inflation in the month of December, yeah, was 0.3, and it was up from the previous month 0.1. But strangely enough, it was down year on year. It went from 2.6 CPI to 2.5. So I don't know how is the math here. It goes up by 0.2, but it goes down by 0.5. I mean, I'm joking because you know, it's the year on year measure is not the same as the month on month measure. But overall, these are nuances that we have to keep in mind, because we need to see that from November to December, of course, we have a seasonal effect of core inflation month on month. It went from flat 0 to 0.3 in December. Why? Because you can go and watch my seasonality for retail sales in Q4, where I analyze. I've been going through the retail sales data for the UK economy, and and I explained that there is a seasonality effect like everywhere in the world. Where it's Christmas season, prices tend to go up because demand is higher, and there is more footfall in shops and stuff like that, even online shopping. So there is a seasonal effect that we see month on month, but year on year, the year-on-year figure, I struggle to believe it, because in December, the Q4, the last 3 months of 2023, and now we are talking about 2 years ago, almost, the economy was in recession, growth was negative, and especially the month of December, the GDP figure were negative, and so I struggle to believe that prices of December in 2024, they were lower by 0.1 than December 2023. This seemed to me a bit of Chinese data. It just put out something, but they could not hide the fact that on a month-on-month basis, prices, they went up from November to December. But we still have the same, the economy still is in the doldrums, because the RPI is 3.5, and RPI is the index factor for the inflation-linked yields. And rent inflation is still at 7.6%, and I show you the other day that the compounded rate of inflation, it's somewhere north of 60% for rents in a year. So these and services, they went from 5 to 4.4%, which is somewhat good. But we are tweaking around percentages on the inflation. On the inflation level, which nonetheless it's good that it goes towards the 2% price stability target. But anyway, CPI 2.5%, it's acceptable from a monetary policy standpoint, I would rather assume. But still, there are some other measures, RPI and core inflation and services, which are well above the 2%. And there is this, as I was saying, the bull market for bonds, it's over. I think that from country to country, the bond market will have to price higher yields, higher mark-to-market yields, and they will ask for higher real yields, because also the overall quantity of debt, it's a lot more. So there is a lot more uncertainty about the debt exposure of any given country. So I saw the other day that the United States in the past 3 months, past 6 months, they spent something like north of 600 billions only in debt servicing, which is only paying the interest of that. So we don't realize that our governments, they are printing money just to pay the interest on that. Let alone the amount, just paying back what is the amount that has been lent to government. They are barely making it through to pay the interest on that, and we are in this from a public expenditure, public debt and fiscal deficit, the whole advanced economies, they are in this really, really, really precarious and uncertain position that the bond vigilantes, they know this stuff very well, and now they know that inflation is going to be structurally higher for lots of reasons, and so they want higher yields. And it seems to me that here we are on the verge of a breakout. That would be, today is Friday, and so I don't know, it will be next week, I don't know. We hope for the best, and but we need to prepare for any eventuality in the market. And after we will have a look about all the other yield curves in the market, if I have time. Oh, anyway, today I'm having a with you all. Why? Because I'm going back to the inflation-linked yield market, because as I said in the other video where I explained what is in my view, according to the data, what is the underpinning feature that makes so unstable the gilts market yield curve, is this part of the debt which is linked to inflation. and it's easy to see because the nominal amount was 393.5 billion, but the amount it has inflated to 624 billion with inflation uplift. And I explained the other day that this debt security is indexed to RPI, which is 3.5, instead of being indexed to CPI, which is 2.5. So we are like for like. We're paying, taxpayers, they are paying more for the same thing for no reason at all. This is first thing first. And then this index ratio, they will tell you what is basically how the debt security has inflated. So now the index ratio tells me that because it's 2.86 for every 100 pound, if I multiply with the index ratio, I know that the cost will be 286 pound. So the longer the debt goes into maturity, goes towards the expiry date, which is now this is 2030, the larger is going to be the index ratio that serves to update the inflation uplift. So the longer is the maturity of this kind of debt, the larger will become the index ratio, because you have the cumulative factor of the RPI, the inflation cumulative factor, and this will be net of the coupon at which the debt is issued. Here we have 4 and 180, which it's 4.125%. So these are the coupons which seem to be very cheap, but when you factor in with the index ratio and the long duration of this kind of debt security, then you start running some sort of troubles. Yeah. Why I say that? Because basically, if we go here, we see that, for example, on the 22nd of Jan and 26th of Jan, we have a couple of dates where the government or the DMO, they have to pay a couple of coupons, you know what I mean? And these couple of coupons, they would sum up to 487 million, but this would be using the index ratio. If I do the calculation for the RPI, so basically if I take the past 3 months RPI, that is indexed for 8 months. So if I go 8 months back, I will take RPI from May, which is 3%. The RPI factor is 3.3, so the two coupon that the government will have to pay, it's 577 million pound. And don't ask me from where this money will come from, because it's 577 million or 480 million. It's a figure which is very similar to 600 million of China. You know what I mean? So and you'll be left with some spare change like that. So what I'm trying to show you that the index ratio on the 13th of January was 2.86, but these two, you see dividend there, they are indexed with 8 month lag. So if I go 8 months back from May, I see that the RPI is 3%, and if I do the factor, then the true cost is 577 million pounds. And this is a coupon that it's paid on Jan, and it's not owed because it has to be paid twice a year, every 6 months. So it will be paid again on June or July, and this is for all governments around the world, for the American, for the French. Sovereign debt, it's a semi-annual coupon bond, so it pays its coupon every 6 months. For all the pensioners that are lucky enough they have savings in sovereign debt, they know that they receive a coupon every 6 months, which is normal. If you pay tax and you pay tax and then you do double your due, and you even lend money to the government to whom you pay taxes. Well, so there's nothing bad about that. It's something if all of this is sustainable, and to me it's not sustainable, and it shows it for itself, because inflation uplift seems 624 billion, but this could be higher, while basically with the 3 month lag indexation they will have to do the calculation again for the index ratio. So if RPI is higher, then the index ratio will be higher, the uplift inflation factor will be higher, and then the coupon will be higher. So I've done a brief calculus here on Excel, and so next week they should come up with something between 487 million and 577 million. It depends which kind of index ratio they will apply. And then for the whole of Feb, there will be something around 47 million. And all these coupons that are due on the 22nd of March, it's about 434 million. And then there will be 950 million. So the overall, it's a little bit less than 2 billion pound, and we can make it, this is one coupon, because the coupon is twice a year. Only for that, we're talking about 3.8 billion, nearly 4 billion pounds to service this debt. But we see that if you see here the duration, if you can see, I hope you can, let me make it larger a little bit. All right, we see that 2030, 2035, 40, and we go up to 2050, 2058, the longer duration, longer duration is 2073. You know what I mean? I won't be here talking about this thing, and I could spare myself to do that. So this is another feature that anybody who does this job, who works at the Exchequer, who works in any debt management office, work at the, I don't know, in the US Treasury Department of the United States, or you work at the Euro Area Finance Minister, you work, I don't know, in Australia, you pick bananas in Africa, you should know that the longer is the duration of the debt, the more riskier it's this debt to manage from a risk management standpoint, because this is basically the value of this debt, and the cost of this debt will vary according to interest rate volatility, and this debt is particular because it's also linked to inflation. So if you have another from today, 2024 to 2050 or 2060 to 2070, you have a series of inflationary shocks or interest rate shocks, then this debt will cause you a lot of trouble. And we know that common rule would be that the overall stock portfolio in public finance, the average duration ideally would be between 7.5, 8 years. So in aggregate, when you have a bunch of security, you have a stock of bonds, you have a portfolio of bonds that you're managing, you want to make sure that the bond portfolio is balanced, at least in public finances, basic notions that I've learned. And the average duration should be between 7.5, 8 years, less than 10 years. So you have some short duration, 2 years, you have some medium duration, 5 years, some longer duration, 10 years, you make the average, and then your bond portfolio, basically the modified duration, it's around 7.5 years, 8 years. But we see here that these debt security are kicked in the long grass, and so the Exchequer and basically the UK economy is left exposed to all sorts of inflationary and volatility and interest rate volatility, which is not a good thing from a risk management standpoint. I really deprecate this stuff. I don't know why they do that. It's still an unknown to me, and I will show you. I managed to ask the machine to calculate. So here we see that the average inflation uplift cost by maturity, so from 2026 up to 2030, we are north of 10 billion. And this north of 10 billion, it's only servicing the debt. So paying off the inflation uplift, which is paying the coupon. And then 8 billion between 20. So the maturity group, it's when the debt expires, okay? So it's the duration of the bond, the gilt. So for the group, the gilts that expire between they arrive to maturity between 2031 and 2040, we have an 8 billion per year of inflation uplift cost. And so we see that 2041, 2050, we are between 6 and 8 billion, 6 billion, 2050, 2060, and 2061, 2070, we are north of 6 billion, for inflation uplift cost, and we kick in the long grass with the 2073 absurdity. And yeah, here we have basically the modified duration for all the inflation linked debt, and they are scaled. Basically, they are yeah. So they are. We see here when they expire. The year of redemption is 2027, or the year of maturity, where the bonds get to maturity, and theoretically the government will have to reimburse the whole amount that they have borrowed, or they can issue other debt. So they issue other debt, they pay off, and they still have the debt rolling over and over and over. This is common thing that the United States does all the time. They issue debt just to pay off the other debt, and they keep the debt rolling and rolling and rolling. So it's not a surprise that deficits and public debt, they keep inflating, because it's mismanagement. I mean, it's not a good practice to keep to do this stuff. And yeah, we see here the average modified duration for the entire stock of debt, which is only the inflation linked debt, it's 18.83 years. So this is the first weak point, the first weakness of this part of the debt, which is linked to inflation, which has a very long modified duration, which is 18.8 years or 19 years, which is very long. It's twice what is recommended to be the modified duration of a bond portfolio in public finance, which should be between 7 and 8 years, or 7.5 years. And here we have the chart where all the modified duration and all the correct respective index yields are plotted on the x-axis. So we see here the 2073, it has 40 plus year duration. Sorry about that. So right, so I showed you here that the average modified duration of a whole bond portfolio, or the stock of debt that it's linked to inflation, it's well north of 18 years, and it should be between 7 and 8 years. So for my own curiosity, my intellectual curiosity, and practicing around this stuff, I decided to to take the real data and to figure out what to do. So basically, I think that I mean, I had an idea. Let's call it an idea. I said, what would be the best thing to do, or how to rescue and salvage this stuff and save out this thing. I say, okay, if the government is exposed to inflation and to interest rate risk, why don't you basically start to issue zero coupon bonds, and by sort of restructuring the debt, and basically you stop rolling over the inflation index part of the gilt market. So these things, it's not a small thing, okay? I think this will make maybe I'm exaggerating, but this will make any Chancellor of the Exchequer like famous as Gordon Brown, as he gave monetary policy independence to Bank of England. So I think I don't know if this is a good idea or a bad idea, but zero coupon bonds for sure they will save a lot of money in public finances. So a big change in public finances will be basically the restructuring or the substitution of inflation-linked gilts with zero coupon bonds. And zero coupon bonds, they can be they are very functional to pricing the zero coupon inflation swap curve. So from that point in the market, there should be no issues. The thing is that zero coupon bonds, they don't pay a coupon, and so this will need a big talk with large pension funds and investors, and basically the big people who buy the UK debt in markets, the primary dealers, and say, okay guys, we need to do something, and we want to issue zero coupon bonds, and you let to buy this stuff. I don't give a damn. And I mean, investors, they would be more interested in have inflation linked debt. So this is the first hurdle. So when you have basically primary dealers that go into the DMO auction, and they bid in the primary market for the gilts issuance, then you will have to have an agreement with this fund and say, okay guys, we need to switch the composition and the structure of that we are issuing. We're gonna issue zero coupon below par, and we give you this this return. But the return on the bonds is very much predictable, because a zero coupon bond, basically you discount it for the prevalent yield for the number of years, which is the duration of zero coupon bond, and you issue it at par or below, not par, you issue it at below par price, below £100. Let's do an example: a zero coupon bond with a 2-year, 3-year duration, and the yield is 4.75. Roughly the price would be, for example, £90. So the government issued this debt, which expires in 2 years, and the government receives £90 from the market, but it has to pay after 2 years. In the interim, in between periods, you don't pay any coupon, you don't pay nothing. But after the 2 years, when the bond gets to maturity, then you receive 90, you pay 100. But basically, if you discount the real value of the £100 that you pay after 2 years for inflation and interest rate, then you'll see that basically you won't have a loss in public finances, and maybe you can even save money, which is a complete in my knowledge, this would be entirely beneficial for the management of public finance. And so you can basically restructure the index linked part of the overall debt that it's managed, and you replace it with zero coupon bonds. And zero coupon bonds, they don't have long duration, but you can issue it for up to 10 years, which is very long duration. But I mean, this would require a sort of agreement between pension funds and all the institutional investors, I say again, that are primary dealers, and they would have to agree with the government, with the Bank of England, that they will bid for zero coupon, and they will have a certain return guaranteed in the market. And then they can go and do all the fancy stuff with interest rate derivatives, and they can take interest rate swap, they can use inflation swap if they want to hedge from interest rate volatility. But these are stuff that it's for investment funds. So we can see here that the machine took the entire index linked treasury gilt outstanding, and I asked the machine to create 4 tranches: 3 year, 5 year, 7.5 year, and 10 years, because my objective is to restructure the debt, replace the inflation debt with zero coupon, and to shorten the duration of the portfolio and balance it between 7 and 8 years modified duration instead of 18 years, which is now almost 19 years. And here in details, you can see that at period 0, for example, you'll have to issue 1.6 billion of 3-year zero coupon bonds, 2.7 billion on 5-year zero coupon bonds, 3.8 billion on 7.5 year zero coupon bonds, and 2.744 years of zero coupon bonds. That, I mean, this is the duration: a 10-year zero coupon bond, a 7.5 year zero coupon bond, a 5-year zero coupon bond, 3-year zero coupon bond. So and this is the amount. So the machine was, according to my instruction, was able to period by period tell me the amount and the duration of the security that has to be issued, in order to have the final result that the weighted average duration of the portfolio would be 6.83 years, which is not 18.83 years. So we are shortening the duration by 12 years. Here we have 6.83 years. We are simulating to restructure the debt by issuing in 4 different tranches 3-year zero coupon, 5-year zero coupon, 7.5-year zero coupon, 10-year zero coupon, and period by period we're issuing an amount that it's able to pay off the outstanding debt, so that this debt is not rolled over, it's paid in full, and then you have zero coupon bond that will have to be serviced when they get to expiration. And here, yes, we have a graph chart with the present value of each gilt discounted for the prevalent SONIA rate, which is 4.75%. And yeah, we have here this 2027, the present value is well north of 25 billion. So we are not talking about small change, but the outstanding amount is 624 billion. Yeah, this is a chart where I can see the duration and to expiry for each gilt. And the only data that I'm missing is when the debt security has been issued, and that would be very helpful. I can find it, but I didn't have time to do this bit of work. And yeah, so here we see what would be the tranches allocation for each gilt when we are doing the substitution with zero coupon issuance, right? So for example, this north of 25 billion, we'll have to issue like between 6 or 7 billion of a 10-year zero coupon, and then we have this green bar, which is 9 billion in 7.5 zero coupon, and here we have 5 billion, like a little bit more, 5 to 6 billion in a 5-year zero coupon, and let's say 4 billion of a 3-year zero coupon. So this chart is very useful to see for each index linked gilt, and when it's expiring, like 2030, 2035, 2028, for each of the debt security which is outstanding, how I'm going to substitute, I'm going to integrate the market with liquidity and substitute the index gilt with a zero coupon. So no more coupon to pay every 6 months, it's just one lump sum at expiration. But as I said, when you discount the par amount, this is of paramount importance, when you discount the full amount by the prevalent rates in the market at expiration date and the cumulative cost of inflation, then the government for sure will have saved some money. And here we have a very nice pie chart, where we see that 25% of the overall debt will be in 10-year zero coupon, 15%, 25%, 35%. So if you see, I basically decided the weights of allocation to follow a normally steepening yield curve. So I put 15% on 3 years, and I put 25% in the belly of the curve, 5-year, 35 on 7 years, 7.5 years, and 25 on 10 years, so that I don't have a runaway long between 10 and 30 years. I don't have a runaway breakout of high yields. I tried to balance the weight of the portfolio to have also a good correlation with the yield curve, so that I'm well anchored in the belly of the curve. I'm not so heavy in the 3 years, so that the yield curve does not become inverted. Yeah, and like an inverted yield curve is this one, when I have short duration that it's higher than the long duration. And also by having a normal yield curve that it's priced to the bootstrapping of the zero coupon, then I have 25 weight on a 10 year and I don't have runaway higher yields. So just have a normal yield curve, right? And you can structure the weight of the zero coupon issuance to have the yield curve well anchored, and then you'll have two kind of gilt issuance, which is the normal traditional gilt issuance with the market yield and the coupon, and zero coupon. That's it. And we get rid of the inflation linked gilts, which is exposed to inflation volatility and to interest rate risk. So yeah, this is the scatter plot of the exposure of what is the actual debt that is in the market, still only the inflation linked part. And yes, I did some more other calculation, because I figured out that the amount restructured is 624 billion. The amount restructured, I'm going too far. My starting assumption is that I have 624 billion, and how I allocate, and I added a 2-year period, 0.2 year, just to spread more, because 624 billion is a lot of money. And here you can see what is the allocation. Yeah, 10% on 2 year, 15% on 3 year, 25%, 30%. So we are just a bit more heavier on the belly of the curve, lighter in the front end, and the longer duration, which we want to have more or less a normal behaving yield curve, a normal convexity in the yield curve. So, and then yeah, this is the present value, which is discounted for the 4.75% bank rate. And yes, this is the allocation, the theoretical allocation. This is the present value of the theoretical allocation. So we see that the present value of a zero coupon bond, when you discount it by the prevalent rate in the market, I use the Bank of England bank rate, it's lower. Okay, so when you are paying back, even if it's a lump sum, then you will not be paying the real nominal amount, but the present value of the discounted cash flow according to the prevalent yield. So that's why zero coupon are very, very useful, because you can do a stripping or a full Monty bootstrap of the zero coupon. You discount the cash flow, and you see that in the end you have saved a lot of money, and in the interim you have not paid any coupon, and you are not exposed to inflation. So that's what I would do. Yeah, and yes, I did some tweaks and changes, and so basically I said, okay, I want to take off, I want to leave out the first 2 years, because I don't want to have refinancing issue and stuff like that. I want to leave out 48.8 billion. So basically I did another calculation, and I excluded the debt security that is expiring in 2027 and in 2026. I say let's leave out 48 billion, and so the total amount of refinance becomes 575 billion. And then I amped up this thing with the discount rate, so it would be 602 billion. If I'm issuing this zero coupon and I discount it 602 billion for 4.75%, I will have this amount of money, 575 billion, which is the amount that I have to use to do this kind of allocation: 2 year, 3 year, 5 year, 7 year, and 10 year zero coupon according to this weight, to this amount: 57.5 billion in 2 year zero coupon, 86 billion, 143, 172, 5 year zero coupon, 7 year zero coupon, and 10 year zero coupon is a very long duration. Zero coupon, usually they are maximum 5 years, but that's why I said this will have to be like a big, huge rabbit out of the hat, magic trick, not a magic money trick, a magic moment where the exchequer says, okay, we want to do that, and we will speak with these funds, and we will give them zero coupons, and we are not going to issue anymore any sovereign debt that is linked to inflation, and this will calm the market a great deal. This is my conclusion. And yes, here we have how the 602 billion pound will be allocated. So we will have 60 billion on a 2 year, 90 billion. We can see here the amount simulated, and this is the other issuance that will be raised in additions. And yeah, then I asked the machine to give me 2 scenarios if I want to do that on a 10-year time frame or on a 5-year time frame. And so according to how I'm gonna spread out the restructuring of the debt, we'll have a different kind of amounts that have to be issued according to the debt maturity, more or less. No, these are pretty much the same. So probably there have been some disagreements in the issuance. Okay. Yeah, sorry. So these are the amount that had to be refinanced, okay? The total amount. So on a 10-year plan, Okay, at period 0 I will have, for example, 5 billion issued, and I will have to issue 5,490 bonds. And why 5,000 bonds? Because the face value of each bond will be 1 million. Okay, and I ran this simulation for 1 mil and 10 mil. So this, because the amount, the size of the investment that is required up front is quite large, this would be this would be only for primary dealers. I mean, normal savers, they don't invest 1 million in just one debt security. Okay, so this would be stuff for primary dealers. They will have to be 1 million or 10 million at a time. And so here I have in details the nominal amount and the total number of bonds per year on a 10-year horizon, which is 5,000, and this is the amount that it's 5.5 billion or 7 billion and 860 million. This is almost 12 billion, 13 billion, 7 billion, and this is basically 0, 1, 2, 3, 4 are 2-year, 10-year, 5-year, 7-year, and 10-year duration. And these are the number of debt securities that will have to be issued spread on a 10-year time. Now, if we narrow down to 5-year horizon and we want to compress this restructuring of the debt, then we see the amount to issue is the same, and the annual issuance, it grows from 5.5 to almost 11 billion, and also the number of debt securities, which the nominal amount to bid for is 1 million, it grows. It require almost 10,900 per year issuance of each kind of, this is 2-year, 3-year, 5-year, 0 coupon, 7-year, 0 coupon, 10-year, 0 coupon. Okay, so this will be the plan for on a 5-year. This will be the plan on a 10-year. It's like I'm a man with a plan, you know what I mean? And yeah, so this will basically sort out the inflation-linked gilts exposure. And these are other simulation with the weights of allocation. Okay, so 12% will be on a 2-year 0 coupon. The nominal amount will be 5.5 billion average of issuance, and we see that, yeah, this is on a 10-year horizon. You will need 5,490 debt securities. Each one will be priced at 1 million. That makes 5 billion or something like that. And yeah, we see here that then the average duration of the portfolio, it shrinks to 5.7 years. Okay, which is, I think, maybe too much of a short duration. Then you can change around the weights and the composition, but then you're sure that you are not paying coupons, and then you can easily refinance the debt issuing another 0 coupon. And if interest rate they start to go down, then it's more convenient for you to issue 0 coupon, because you are not discounting. The lower it's the interest rate, the closer you are issuing at par. So the government will issue with less and less loss upfront, less with a lower. Instead of issuing at 4.75%, when you issue at 2% and you discount the cash flow for 2% for 2 years or 10 years, then for £100 probably you will receive 98. But when you issue 4.75, maybe you will receive £94. That's the money that the government receives, discounting the cash flow for 4.75. But if I discount for 2, maybe the government will receive 98, and then it will have to pay back 100 or 101, and the government will probably make a profit on this, because when you invest this money into economic growth, then you'll have GDP growing faster than that, and then you'll have a whole other ball game in public finances that will be a lot better than what it is now. So here are the graphical charts for that. So the annual issuance 2 year, every year you will have 5 billion in 2 year 0 coupon, 7.8 billion of 3 year, 12 billion or 11.8 billion or 12 billion of 5 year. Yeah, 12 billion on 5 year, and yeah, 13 billion of 7-year zero coupon and 7.5 billion of 10-year duration zero coupon. This is on a 10-year time frame. If we shrink to 5 years and we want to make it an average, we see that instead of 5 billion, we have 10 billion in a little bit more. We have double the amount basically. So we divide by 2 the duration, and then we have to double the amount of issuance. So every year you have to issue more than 10 billion in 2 year zero coupon. It's easy to read. 15 for the 3 year, north of 20 billion in a 5 year zero coupon, 25 billion in 7 year zero coupon, and almost 15 billion in 10 year zero coupon, which is a lot of issuance. So maybe the 10-year horizon will be at a pace that will not be so much stressful for the market for that issuance. And basically this issuance will have to be used to pay, not to do investments or to basically to extinguish this exposure, which is the inflation-linked gilts, to pay off this amount. Okay, so instead of rolling over and issuing this, you want to pay off this 624 billion, but when you start to pay, when you have a debt security is expiring in 2054 and you are redeeming this in 2034, 20 years before, then the cost of the debt, of course, it will be less, okay, because you don't have to pay the whole inflation uplift, and so you will be paying less than 600 billion. When you pay that before it expires, you've saved a lot of interest and inflation cost. So this overall issuance, this plan, it will save you money, and basically it will leave you with some fiscal headroom also to do investment, and that would be net of coupons, and it's not exposed to inflation volatility, and it's only exposed to interest rate. But if you are normalizing the debt composition, then interest rate they should be more well behaved. Yeah, this is another simulation. If we exclude the 2026 and 2027 expiration, we know that the amount is 602 billion for all the inflation-linked gilts that arrived to maturity between 2028 and 2073. And yeah, this is the same. Basically, on a 10-year time frame, the amount that has to be issued according to 2-year zero coupon, 3-year zero coupon. This is the 5-year, and yeah, this is the allocation made for amount. So on a yeah, I think this would be on a 5-year horizon. A total amount 176 billion on a 7-year zero coupon. These are the total amounts. Yeah, 150 billion in 5-year zero coupon, so forth and so on. 125 billion and 24 billion for a 10-year zero coupon. And yeah, so basically this is the exercise that I've gone through with the machine, and I liked it a lot. It was very instructive and illuminating, and yes, so yeah, these are average issuance. The average duration shrinks to 5.7 years. Yeah, this is a 10-year bond portfolio allocation with zero coupon, and you have 12%, and every year you have to issue 5.5 billion of 2-year zero coupon. Then you have 17.1% of 3-year zero coupon. These are the weights of the portfolio. The horizon of the bond allocation is 10 years, and the modified duration will be 5.7 years, maybe a bit longer, but well in the parameters of public finance management. And these are the amount that have to be issued every year according to the kind of debt security, the zero coupon that you're issuing, and these are the weights. So I hope you enjoyed this video. You find it very insightful. Leave a comment, just tell me if it's a good idea, it's a bad idea. If you, I don't know, if you would like that UK government will take my idea and implement it. With this, I wish you all the best. Have a good productive day, enjoy your day, and see you soon. Take care. Alright.